Hall, Commercial Broking Director for the North.
Hi, I'm Kirsty Ford, Commercial Broking Director for the Central Region.
I'm Tim Wilkinson, Commercial Broking Director for the Midlands.
Hi, I'm Matt Godfrey, Commercial Broking Director covering Wales and South West.
Hi, I'm Ian Jackson, Commercial Broking Director for London and Thames Valley.
Hi, I'm Greg Taylor, Partner and Head of Banking and Finance at MHA. Hi, we're here today as the Banking and Finance team to talk about the lending conditions we've witnessed in 2023 and what the market conditions might look like for 2024, including our predictions. So some key facts for you from 2023. The UK economy has performed better than expected in 2023. At the start of the year, market consensus was GDP may fall by 1%, but economists are now predicting that 2023 will actually see growth of 0.5%. Inflation has fallen from 10% in January 2023 to 3.9% in December, taking the rate of inflation to its lowest level in more than 2 years. In January 2023, the official Bank of England base rate was 3.5%, but by the end of the year, it had risen to 5.25%, with the last increase in August of 2023. So, what I want to know, guys, is 2023 was a difficult year for businesses, with rising input costs, inflation, interest rates, and high level of energy costs. So what are you expecting in 2024 in terms of the economic backdrop in?
So I think 2024 is still going to be quite a tough year. There's still a lot of uncertainty. We will have, I suspect, a general election come up.
Yeah.
We don't know what impact inflation is going to have on interest rates and how quickly they may change. I think on the positive side, what you have got is you've got businesses and consumers that have got used to higher costs from the point of view of your fuel costs, your household bills. And so you're almost entering into a period where people will start to have built that in, which they clearly couldn't have done over the last couple of years.
Yeah.
So I think we'll see a better year in 2024, but there's still some uncertainties around as to how much better it will get for everybody.
Carl, do you think it'll be more stable in 2024?
I agree with what Ian's saying. There's a new norm, as it were. We often get asked questions around interest rates and will interest rates go down. I don't think we're ever going to see interest rates as low as they've been in the last 15 years, a generation of rates. However, I believe from the research that I've done and the conversations I've had that depending on the election, we may see rates reduced to sort of 4.75 by the end of the year. But yes, there is a new norm. People are used to spending a lot more now, and there are still tough times ahead.
To echo what everyone's saying, there are the inflation pressures, there are the interest rates. On a positive, we're probably in a better place now from more of a funding market position than we were at the start of last year. More lenders are coming to the market now. They've got a better steer on the products, on the rates that they're offering. So we probably have got a great opportunity now for our clients as well going forward.
I agree with Matt. I mean, lenders have been stress testing at base sort of 3.5-4% for the last 10 years or plus. So we are there now. We'll be on there. So margins haven't really changed from a lender's perspective. Margins are still relatively the same and relatively competitive. The problem we have is that obviously base has gone higher, but their stress testing hasn't changed that much. So providing they can still prove serviceability, there's a lot of scope for clients.
I think it's very interesting because yes, the stress testing is still there, but what we've got in the backdrop to this is a general decline in asset values. So that's again being factored into the lender propositions, which I think leads on to that watchword for anybody that's interested in financing, refinancing, is everything is taking so much longer now than it ever used to. And that's a function of the market that we're all in.
So Kirsty, so demand for finance, I think we can all say was pretty stagnant last year for new finance for us and across the market. Businesses being understandably cautious about taking on new finance options, opting instead to use their own resources to meet their financial needs. What do you think the demand for finance will be in 2024 from businesses looking for finance?
I think the demand is increasing. I think businesses are starting to look at their strategic plans for the next 12 months, and that is increasing. They're looking to grow and push in different areas. And where interest rates are slowly starting to come down, they are looking to invest more in their business.
I agree. I think banks' appetites have certainly grown, and for every bank's appetite that has diminished, another bank has stepped in and said, well, we'll take up that mantle. But I think businesses have been cautious the last 12, 18 months, certainly since the mini budget of Liz Truss and Kwasi, to see what was going to happen. And I think we've now got a bit more stability in the market, so therefore people have waited, and it's now time to pounce.
I agree that there certainly is more of a demand for finance feeding through. I think expectations of the client and indeed some of the advisors are probably built around the old world in terms of, again, speed of delivery by the funding institutions, but also the cost of those facilities. And so getting the right guidance at the right time, and with a backdrop of rising corporate insolvencies, certainly compared to pre-COVID days, I really think the importance of the right guidance when looking to fund either short-term or long-term debt solutions is absolutely critical these days.
I think what you also generally find in this type of situation is there'll be those entrepreneurs that will see the opportunities, will see the new markets, whether it's an acquisition that they take on because they can see a business where they can improve it from where it is, or just that entrepreneurial side where it's how do you diversify currently what you've got which complements what you do, or actually another division that you can bring in that again you can see where there's added value in having those clients and how you can spin them off into working in both aspects of your business.
So new figures released by the FLA, the Finance and Leasing Association, show that total asset finance volumes grew in November 23 by 12% compared to the same time the year before in 22. And in the 11 months to November 23, new business was 13% higher than it was in 2022, while financial products like term loans and overdrafts have been less popular. So what do you think will be the financial solutions that businesses go to in 24?
In 2024, I think we actually probably follow the same trends. Because like the overdrafts and standard loans now become a lot more difficult, a lot more costly to the clients, and also it's not really something which banks want to provide. So from a more of a trading business perspective, we could be looking at an increase in the asset finance, looking to release cash out of the asset they already own, plus also buying new kit and equipment. Invoice finance to help and to help with cash flow, because obviously cash is key this year. So if the clients actually release what they've got to then further their business, I think that would be one of the key areas.
Yeah, I think that's very valid, Matt, because the other side of this is, the invoice finance market. I think many of us who have worked it in the past have naturally assumed that was going to improve and increase over the last few years, and it's clearly not. I would say, from my opinion, from the point of view of COVID and the cash that came into businesses that supported it, but at some point that has to change. I think the other side of this is, of course, that there's a natural look now and a consideration for sustainability. So therefore that investment into assets that are better from the point of view of their productivity, what enhancements they can make, and all that needs cash. And now whether you want to look at that on a term loan, which again lenders will be very keen if it's for green related transactions, but ultimately you touched on the words very clearly at the beginning, and it's very, very true, and that cash is king, and without cash you can't realistically survive.
Asset finance is going to continue to grow this year. I think where cash is king, everyone's starting to realise that they need to utilise the asset finance option a bit more and keep the cash safe. All the green options, so there's a lot of people going into the electric cars, looking at the solar panels, so all the asset finance and that side of things really helping as well.
I think with regards to asset finance, then the super deductions have very much driven that market, I think, and when that starts to fall away at whatever confirmed point that eventually turns out to be, we'll see a refocus on perhaps refinancing existing assets, and also going back to Matt's point, looking at perhaps the more alternative forms of finance that are still deemed as receivables finance, asset-based or asset-backed lending. And that will be a real interesting area of market that I think we will see growth in.
I think property market's going to be a very interesting one for this year. There's obviously going to be the budget. I think there's a clear demand to consider what's done for first-time buyers, because that does drive some of the market. Depending on what happens with that, the other side of this, of course, is and interest rates, is therefore the rent versus what people can now afford on a mortgage, and those multiples, and you're seeing the mortgage offers coming down and the rates coming down, so therefore someone who could be paying X amount in rent may well then start to take the view that actually they can afford to pay that in a mortgage payment as opposed to the rent. The reverse of that will be where they get deposits, because the challenge could be the deposits. I would say the bank of mum and dad maybe isn't quite as favourable anymore, because when the bank of mum and dad couldn't get interest on their savings, they can now. Yeah. So I think that puts a real flux on the buy-to-let market. And again, you're seeing that with the offers out there with regards to low interest rates but very high fees, which is how some people may retain their buy-to-lets. And then you've got obviously people who've been more conservative can probably get a balanced interest rate but with a lower fee. So I think there's going to be, for those investors, almost what's their belief in the capital growth of their portfolio over the next 5 years, and do they pay the fee, because that keeps their payments down at the moment but will enhance their income because they'll be able to manage their rentals accordingly.
I would agree exactly what you're saying there. The property market will be interesting. Going forward, we're going to probably see more of the professional landlords coming to the table. The people who have got the portfolios there, the cash available and full affordability. It's gone from clients always getting the 75% to now what can we achieve, which is what we need to take advantage of the rates and the offers that are around. Other regulation as well is when we look at the EPCs. Yes. It's not just now can I afford to maintain my mortgage payments. It's also can I actually afford to maintain the properties to make sure that the level which are going to be requiring. The good thing about the market though is that the lenders are on this as well, so they're bringing out products to help you with improving your EPCs. They're bringing out products, like you said, with the lower interest rates but the higher fee to make it affordable to get onto the market.
I agree, and again I come back to the point earlier, it breeds opportunity, because there will be, in certainly the buy-to-let market, the development markets, there'll be investors that are looking long term now as opposed to the quick wins, but then also it's that rent versus buy piece. So when you've got your commercial tenants and their landlord are coming out of that market to say, well actually we'll buy it, so we've got a manufacturing business that wants to buy their premises, and actually we can facilitate a commercial mortgage to show rent versus buy. We've got a proven track record that they've rented it through their accounts on lease, and then ultimately we can then go and get that forward, and that then adds an asset to their business, whether it be owner occupied or opco propco. But again, it just breeds opportunity, and I think we're very suited to support them.
Last question, guys. Predictions time. So what I want everybody to do is put your predictions for where will interest rates and inflation be in December 2024.
I've already put my neck on the line on the chopping block for 4.75 is what I'm aiming for, and I believe that's achievable for certainly December of this year. Inflation, wow, no one's got a crystal ball. What, are we at 4%, I think, now, are we?
Yeah.
So, depending on how the election goes, depending on what happens in the rest of the world, it obviously impacts us. And if interest rates stay high up until Q4, then yeah, I'd like to think maybe inflation could fall to, say, 3% maybe.
My predictions, interest rate, I think, are going to drop down to about 4.25, and inflation is going to, I think, in the 12 months, it's going to hover between 3 and 4, but will end probably closer to 3.
Interest rates, I'm going to go with 4.75. I think there's going to be limited scope for manoeuvre over the period of time that we're looking at. I think inflation, I'm going to put I'm going to put my money on 3.5%. We've got geographic events in the Red Sea to consider, together with ongoing issues around the world. So it's pretty unstable, but yeah, it's still very much a new normal.
Interest rates, I think, will drop to around 4.5. Again, wait for the general election, see if anything happens from there. With regards to inflation, they were saying in December it should drop to around 2.1 by end of this year, but obviously we had an increase to 4%. So I would guess around 3 to 3.25% inflation.
So on interest rates, I'd love to be as optimistic as I think some of the people that you've seen come around to say that they could get down to 3.5 and we could see 6 drops this year. I just think that's probably a little bit over the top for the UK economy and how cautious we are as a country. I hope it's around 4.5. I think we can probably see 2, maybe 3 drops. Inflation, I think, is a much more difficult one to balance because of the likes of the situation that Tim's touched on. We have an election. There is, don't forget, also potentially, well, there will be the one in the US, if I'm correct, for this year. That opens up uncertainties, bearing in mind how closely allied we are to them. I think it's probably about 3. I can't see us getting down to the numbers that everybody wants at 2, but I would have hoped that about 3 is where we might end up.
My predictions are a bit more bullish. I think that interest rates potentially get down to probably somewhere near 4.25, and I also expect inflation to get down to roughly 3% by December 24. You've heard what we think. We'd really value your opinions. Please let us know down in the comments what you think. This team here, the Banking and Finance team at MHA, is a commercial finance intermediary and business advisors. So if we can help with any of your commercial finance needs, please get in contact.